Hello, everybody, and welcome to tonight's session of Simply Funded. We are launching a series for the foreseeable future where we're going to be bringing on guests in order to talk with us about real estate, either their real estate journey or things that they are able to do to help us buy our first house, buy our 10th house, buy our 100th house, whatever it is. And Tousif Rahman is here today because he is a bookkeeper. He's a mechanical engineer, which is interesting, but he also helps people with regards to their financials and creating their financials and setting up your financials so that you can get the maximum amount of deductions. So the reason that I started talking about this high income, lower your taxes is because some of us are W-2s. And, depending on how much money we make, we can look at that tax bill and go, ouch, I have to do something, because the government keeps taking money out of our W-2. So I wanted to come and have Tusif tonight just kind of talk with us about real estate investing overall, because he is also a real estate investor. He's getting into it. Different things that we are able to do in order to reduce our taxes and just other information as well. So, welcome, Tusa.
Thank you. Can you guys hear me?
We can hear you just fine.
Awesome.
Yes, yes. So, why don't you start off telling everybody a little bit about yourself?
Awesome. By background, I am a mechanical engineer, as Sherry said. Came here a few years back. It's almost by 5.5 years now in the US. But when I first came as an engineer, started my job, unfortunately, someone did my tax so bad. I made, I think, $3,000 ish, and I owed IRS $700. And I was stunned. I was so excited to start businesses at that time, even though I learned a lot, didn't make much money, but learned a lot. But quickly started studying that, hey, if we are going to be making money in US, we need to understand the tax law. You don't need to know everything of tax laws. We just need to know enough that is going to strategize to avoid us from those shocks. So started reading about those IRS codes. Anyone can do that, but the problem is it's a big task, 80,000 page
It's
plus.
big and it's boring. Yes.
Yes. So have been studying those, and also one of the best things that I feel like investors or the entire IRS codes allows is to more of incentivize the investors. We're
Mhm.
going to go deeper into that, but when I learned that, I literally got into real estate without thinking a second thought, and got my first couple of deals and was able to write off almost half of my engineering income last year. Of course, it depends also on if you want to keep
Mhm.
taxes, because sometimes it actually helps. Especially if you're an immigrant trying to bring people to US, you need those. But other than that, if you're in real estate and if you're paying taxes, something is wrong. So that's how I personally found out. We're going to talk about that. But to give a background, mechanical engineer, tax enthusiast, real estate investor, and now working to become an IRS enrolled agent.
Mhm.
Hopefully this year I will be getting that and will be able to save people a lot more in taxes.
Yeah, so I was a bookkeeper for a while. My mother still owns the business. So, the more organized you are with your bookkeeping, the better off you are uh, with regards to, your business, right?
Absolutely.
It's also very interesting if for everybody who has read Rich Dad Poor Dad or The Cash Flow Quadrant, but even in Rich Dad Poor Dad by Robert Kiyosaki, he talks about the fact that the wealthy pay close to zero in taxes.
Absolutely.
And the reason is because they earn a lot of money, but they are able to build their wealth astronomically through real estate. And in fact, real estate is the number one way that millionaires become millionaires is through
Absolutely.
investing in real estate. So Joshua here is saying this guy's already taught me a lot and I have a PhD. Well, congratulations. You are definitely going to learn a lot here tonight because Tousif has, he said, 16 things that we are able to deduct. So I'm going to basically pull up your PowerPoint here and I'm looking forward to hearing what you have to say.
Awesome. So the way I would love to address this slide, of course, this is just a brief overview of myself. Uh, just to go over first first of all, the technicality, why, what, how of the taxes, so that if there's people more of an analytical brain, they can understand why and how they can even further plan their stuffs, and also some of the strategies that the vehicles that we can use, and also possibly in some of the ones that we can leverage reusing real estate. So coming to the first one, of course, in terms of taxes in US, it is just a tool for control of how the funds are going to move. But what happens is a lot of people think that's a way to take their money away. The problem is 95% of tax codes are written to save you taxes. And the reason that we have a stigma on that, hey, tax planning, reducing your taxes is a bad thing. Unfortunately, it's, I feel like, a installed thing for us as opposed to what it should have been, because the government is incentivizing areas where it needs more funding. Say, for example, if the government needs more affordable housing, instead of them doing it, they just have more tax advantages for people. They just do it way better job than they do. So if you ever want to understand how the tax code wants, see where the government needs money, and you will see every sane government in the world will plan their tax codes like that. To get into the basics, this is one of the favorite, as Shuri was saying about the Rich Dad Poor Dad. This is actually from there. First of all, let's understand the way the tax code works. Just to simplify, from Robert Kiyosaki's four quadrants, the E, B, S, and I. If someone doesn't know that, I'd definitely recommend reading that book. So the biggest way you can legally reduce your tax burdens is to change the type of your income. And understand that the moment someone touches the income, that's taxed. But if you can change a vehicle or put a vehicle in between that, change the type and then touch it, IRS does not tax you at all. That's why in this quadrant we see an employee who is trading their time for money and a self-employed who is actually being pretty similar but just being his own boss. These two people are taxed the highest. We're going to go into it a little more, of course, but not too deep. But just to give you perspective, an employee, when you guys are getting a W-2, you pay 7.5% of Social Security and benefits, and your employer matches that. When you're self-employed, unfortunately, that entire 15.3% is yours. So that's how bad it becomes. But when you transfer that into a big business, you have other people actually working for you, you're getting the time back. Then you get a lot of tax benefits. That's why we see Amazon didn't pay taxes for a good chunk of years, even though they have been making billions. And the last quadrant, being an investor, they become a passive income. The entire type of income is taxed at a different way. The more we understand that, the more we are going to be able to live like the wealthy. And that is how and where the real estate investors reside. Moving on, of course, as I mentioned, why we need to plan those taxes is we need to understand 95% tax codes are for saving tax, not for raising tax. And unless we change our facts, we cannot change our tax. And no CPA can change your facts. Only an individual can change his facts and thus save his taxes. A CPA, an enroll agent, A bookkeeper, all of those tax planners can only suggest what to do, but they cannot change the facts. And the fact that we start leveraging those codes is something that is going to give you back your life and your family. Say, for example, about 20 to 30% of time goes of the a regular W2 employee to just pay his taxes. Think about if someone is working for 60 years, 20 years, sorry, 12 to 15 years goes to just paying taxes. And if you add up all those years of less employment, it also almost becomes 20 years. So we need to be really cognizant of how we do our taxes legally so that we can get our time back. And coming to the different aspects of planning, of course, how you do it is going to depend on what vehicle you use. I love real estate. I put it at the first because that's how most of the millionaires, multimillionaires have been created in the United States. So we're going to take a look at a rough comparison in the next slide, but just so that these are some of the aspects you can legally divert your income and still get tax breaks. You can get your business investments that's going to be treated as a capital contribution. You can put down stocks that's going to historically in the US typically 10%. And we're going to check on that. Of course, retirement vehicle, the problem in that case is you cannot touch it up until you're 59 and a half. Life insurance, asset protection, and legacy planning. Of course, those two are also into the real estate. If you're not using real estate for those, it might not be as efficient. We're going to go through that in really brief technique out there. Okay, now coming as real estate as a vehicle. Why is real estate so lucrative? First of all, being on a economy like the Western economy we have inflation, a little bit of inflation, literally encouraged. So that means doesn't matter where you are at your life, you are going to have appreciation of your properties. As a matter of fact, this is the reason real estate is so powerful, that it hedges yourself against inflation. And the way it comes down to in real estate is appreciation. And the second tier is the cash flow. You rent it out, do short-term, long-term, mid-term, however you want to do it. You pay your bills, then whatever is left is called cash flow. Even if you don't do that, even if it is a loss, you still get a tax benefit. And amongst that, I guess, mother of all benefits, the most meaty benefit is the depreciation. Of course, then we have the regular write-offs and the credits. I'm not going to go much into the credits, but I'm just going to touch upon the write-offs today a little bit, but I'm going to focus much on the depreciation because this might be the holy grail of taxes in real estate, because I feel like this is the way people like Donald Trump was able to write off billions and just pay $750, where a lot of our viewers, including myself, have been paying more in just one paycheck. So that's how the difference become. So just to take an example, say for example, we make a investment that's not the best investment. We only get 7% cash on cash, as opposed to a 10% annualized return for our stocks. Now, that 7% is just net cash flow, as opposed to 10% is something that's called capital gains. That's when referring to the previous cash flow quadrant, this is the different type of income. And when you are shifting the type of income, you're literally shifting your tax rates. Now, if someone were to put down 100,000 on real estate versus stocks, same 100,000 each of them, $7,000 yearly he gets from the real estate and $10,000 from the stocks. On the outside, it's not the best thing for the real estate because you're actually getting $3,000 less. But when you think about the tax benefits, it's much more prominent. So say, for example, that's $100,000 you put down, that was used to buy a $500,000 property. Even though you're not owning or you're not paying the entire $500,000, you're actually being able to leverage the entire $500,000. So, say for example, if there's a land of $100,000, we can still get a $400,000 of actual building. We get a depreciation that's going to give us roughly about $20,000, a little less than that. I'm just rounding up for the sake of time. Now, think about it. That 10%, depending on how fast you got it, you're going to get a tax bill of anywhere between 15% all the way to 40%, depending on what your tax strategy is. And say, for example, that's 15%, lowest tax bracket. That's about $8,500 of that 10% growth out of that $100,000 after taxes. As opposed to real estate, that entire $7,000 is going to be cash free because you are getting almost $20,000 of net depreciation. Depending on what your structure is, you can also use that remaining $13,000 of taxes to take off your individual taxes. So, say for example, on top of that 100,000, you make another 100,000 as a W-2 job. You're going to be able to write off another $13,000 worth of deductions against your W-2 job if structured properly from the same $100,000 investment. That is when it becomes so powerful. That means essentially not that you're only making 7,000, not that you're making it cash free, you're also taking away taxes from your personal W-2 income. Now that is powerful. Now, going to the next step is we are going to be talking about a lot of benefits. Sherry, how long do I have? How deep can I go on these? I can talk about these a long time.
Well, we want to just go for an hour total, so we want to go no more than 7 tonight.
7.
Yeah,
Okay.
so it's another 45 minutes.
Okay, another 45 minutes. So you're planning on keeping a Q&A for 10 minutes?
Yeah, if people put in questions, we'll definitely answer Q&A, so we can save 10 minutes for that.
Okay, awesome. I'm going to speak about 30 minutes then. So the first one, when you're getting into real estate, most of the people that typically comes in, if you're not having a lot of cash in hand, you're typically going to be from employee coming to the self-employed, and then you're going to have a lot of expenses. You can, depending on what you're going to be doing, you're going to structure it either LLC, S corp, or C corp. So consult with a tax professional, tax advisor, to understand what's going to be the best structure for you. And the moment you're going to be getting into it, you can literally write off all the expenses of yourself. This is so powerful because think about it for a second. If you could become the guy every time he goes to Costco for buying gas or buying tissue paper, buying groceries, all of those mileage, all of those gas could be a business expense. That's a huge thing now. One of the good friends of mine said is invest into markets where you want to move or you want to go and travel. Now think about it for a second. If someone loves traveling to Hawaii, he has properties in Hawaii for rentals or even short-term or long-term. Every time he goes there, meets with his property managers, visits his properties, it's a business write-off. How powerful is that? Now you're getting paid to go on vacations. That's how powerful it is. Then the second thing I would love to put down is interest write-off. So I personally don't like interest. I would love to stay as much as away from it. But if someone were to get into this entire leverage in the US economy, he's already got into it, the entire portion of the interest is a write-off for you. So Doesn't matter where you are, if you're already into it, make sure you take that write off against your W 2 income. That is, you act, even if it is a primary home in your personal name, you can actually take it against your W 2 job. That's how powerful this real estate can be. Getting into the third one, 121 exclusion. What it means is, say, for example, you have a rental property that you happen to live there for 2 years out of last five, and you wanted to sell it. You're not going to be paying any capital gains taxes on it up to $250,000 if you are single, and $500,000 if you're married. Of course, in that case, you have to have your married file jointly, but that entire $250,000 or $500,000 is gone, tax free. So you're literally writing off $250,000 worth of capital gains and getting that absolutely tax free. It sounds outrageous, but that's how it is. You need to understand how you're going to do it. And the strategy is you need to fulfill those conditions. You just stay there and move on for your next property. And one of the best combos, if you want to put it like that, because I love combos, because there's almost more than 1,500 plus strategies to write things off. But I love when we can actually take one on top of another. And when you are going to be taking a 2 or 3K loan and living on your personal residence, house hack it, maybe buy a duplex, triplex, fourplex, and then move out or even sell it, you're literally going out tax free. Even though you're living in it, and for you being living on it, you're getting it almost $250,000 or $500,000 absolute tax free. Now it becomes more interesting when you become much bigger. You have so many portfolio, you don't want to pay any tax now. So what you do is 1031 exchange. All you do, buy another like kind of property, but the only caveat to it is you need to buy it within 180 days. Check with a registered agent on those who can help you out with the entire process. Make sure you find those deals. And this is a very, very powerful one. It doesn't matter if you are having a multi-million-dollar business, multi-million-dollar capital gain. Doesn't matter. You're not paying a single dime taxes. And on a broad stroke, I want to say this one is active income can be offset by an active loss, passive income with a passive loss. But when you are transforming those income to more of a capital gains, you're going to have to offset that as a capital loss. Now, when you are actually doing a 1031 exchange, all of that is tax deferred. And if you keep doing it, essentially you're doing it for your entire life. At the end of your life, that's also tax free. So you can literally get your next generation a bunch of properties that you acquired tax free and still have them live a very, very comfortable life. I know a few friends that are personally doing it. That's how powerful this is. Next is travel write-off. As I mentioned, your travel from your house, every time you go to your groceries, all of them can be offset depending on how you structure it. If you want to take vacations, the entire vacation, including your hotel, your meals, part of your meals, your entertainment, part of it. Of course, the tax laws change depending on when you're seeing it. Entertainment can be or may be or may not be written off. But other than that, the entire expense that is occurred, including the travel, transportation, hotel, everything is a write-off. And not only that, you can also include that for your real estate professional timing. We're going to come into that as well. That's a unique and very slick strategy to really, really reduce your taxes. Next one is depreciation. As I mentioned, this is the holy grail of taxes. So on an average, on a broad stroke, IRS allows you to write off or depreciate a residential property for 27 and a half years and a commercial property on 39 years. So if I remember 39 or 37, I need to double check, but if I remember correctly, it's 39. So what it means is if you have $1 million worth of apartment and you take out the land, because land is not depreciable, the entire structure is depreciable over 27 and a half years. That means whatever your income is, that depreciation amount is going to eat up and reduce your taxable income right at the get go, even if you have a W 2 job, if it's structured properly. Now, it becomes way more sweeter when it becomes the bonus depreciation. On real estate terms, we say this is a cost segregation study. So, what you do is you do a cost segregation study, you separate the main structure, which is still 27 and a half years, say, for example, for a residential, and you separate each non essential elements and take their depreciable life much shorter span. Up until last year, IRS allowed you to take the entire bonus depreciation in the 1 year. The current year, they are moving it to 80% and they're phasing it out up until 2027. That's why you'll see a lot of cost segregation studies this year, most likely, to allow them to understand and take advantage of that entire depreciation. Now, just to clear up front, if you are going to be selling that property, you will have to pay a depreciation recapture tax unless you use some other vehicles. That's why I said, as long as you plan the entire tax and your assets through your legacy, you might not even pay a single dime taxes on any of that property. That's how powerful it is. That comes to the short-term rental write-off. What it means is if you are not only having a personal short-term, say for example, we see our friend, one of our friends here, I know him personally, happened to have that, hey, he is trying to rent out part of his house on a short-term basis. If it is 7 days or less, if he works more than 100 hours, he can actually take the depreciation on other properties, other rental properties, and all those kind of stuff, and write all of them off in a single year. That's powerful. If someone is making $150,000 in W-2, he has 3 properties like this, he does a cost segregation on all those bonus depreciations, he can take all of those depreciation in just year 1. That's how powerful it is. So for that, we just need to have one of 7 conditions. You can check it out on IRS website and also discuss with your CPA. I'm not going to be going into the too much details, but just to give you a rough 100 overview, it's going to be you would need to be actively involved into that short-term rental management more than 100 hours. And that is why I always recommend someone to keep a activity tracking log. Because as Sherry was mentioning, her mom is a bookkeeper. The better the books are, the easier it is to get the write-offs. Okay. Sherry, do you think I should take questions in the meantime? I see Eric asked a question, or you want me to?
Yeah, we can definitely take a question right now. So, first of all, T, you are welcome, saying thanks for the content. And before we take Eric's question, I just want to let everyone know that today's session is being sponsored by Simply Funded. We fund real estate deals all over the country. Whether you are a newbie or you have done 100 deals, it doesn't matter. Whether you're doing fix and flip all the way to long term rentals, we fund practically everything. We also have an alliance to even fund commercial deals. So if you've got a building for a restaurant or storage or something like that, simplyfunded.com, we can fund those real estate deals for you. So
Awesome.
With that, we want to come here to Eric's question. If you pay interest on a personal loan used to purchase an investment property, is that interest deductible?
That's an interesting question. Interest on a personal loan used to purchase an investment property. Are you talking about HELOC? If it is a HELOC, then yes. So, for example, you're taking a HELOC to purchase another property, or it's a second position lien for your down payment, then yes, you can. Uh,
Or it could just be a personal loan, like we go to Navy Federal and we ask for when we have high enough income and they give us, 30, 40, $100,000. Uh,
so
but
essentially,
but the question is, would it really be a personal loan or would it be a business loan?
it doesn't matter.
Okay.
Even if you're having it against your personal loan, say for
Uh-huh.
example, it's ultimately going to be an expense, so you can deduct the entire part of it
Okay.
as long as it is attached to the real estate. You have the statements that, hey, from my business or whatever the income is coming in, I'm paying that interest off. You can show that statement, you can take it off.
Okay.
Awesome.
Fantastic.
Sherry, you guys do DSCR as well?
Yes, we do.
Awesome. Just to give a shout out to you guys, then one of the most powerful tool you can get, whoever the viewers are, one of the most powerful tools you can use, trust me, is DSCR. If you don't know what it is, reach out to Sherry, sit down with them, because this is one of the best ways to boost your real estate investments. Because here's the thing, when I first got started, people where I come from, uh, not to be racist, but more being conservative where I'm from, people don't like to take risks. And unfortunately, they took loans against their personal properties, personal names. What it did is that limited the amount of loans someone can get in his entire life on based on his debt to income ratio. But when DSCR came in, I got introduced. Of course, it didn't came in pretty soon, but it was that I get to know it very recently. That changed the entire perspective of investing. All you need is if you can manage a part of that down payment. Say, for example, from your Navy Federal or wherever you want to do it. I actually took a second position lien on my primary home to buy another investment property. That was totally tax free. And when it became DSCR, it did not affect a single dime on my personal credit. That's how powerful it is. I really appreciate Cherry for having that service for us. Anyone who is coming here, reach out to Simplify that Sherry. She's going to be more than happy to take a look at and help your investment journeys.
Yeah. Not only do we do DSCR, I mean, I get very creative. I have two individuals right now who have, let's say, it's not the standard bread and butter loans that we're working on for them, but we are able to actually put a package together and present it to some private lenders. Now, they both happen to be in Northern Virginia.
Awesome.
So, but we get very creative with what we're able to do. So, definitely, if the worst thing that could happen is we could say, no, we're not able to do it. But we get pretty creative in how we are able to help fund real estate deals. I will say one final thing. A lot of people want to come with absolutely no money to the table. It doesn't work that way.
Yep.
However, we have even worked this weekend with a person that needed a money partner, and they ended up ultimately just flipping the property just because it was going to be worth it to them. But we were so creative that we're like, this deal is so good that let's put it out to our network and find you a money partner. And we were
Awesome.
talking about that.
I love it. I mean, to be honest, real estate is a vehicle where you can milk money so many different ways. Someone can actually lend their credit and still make money. So if someone is overwhelmed to see, hey, where should I start? I recommend just start somewhere.
Yeah.
You're
Even
gonna
if it's just a phone call with me,
absolutely,
I'll
absolutely,
lead you in the right direction. Five Pumpkins is asking a question saying, I joined late. Well, don't worry about it. You're here. You're asking if Tousif helps plan and prepare tax returns. Tousif, you want to tell everybody?
yes. I am getting my license to becoming an EA. Up until that, I'm not allowed to prepare taxes of other people. But hopefully after August, I'm going to be able to do that. But I do tax plannings at this time. I'm a business consultant. So, in that perspective, the business consulting side, I can help you out. Sure, you can drop my contact or however you want to share it. You have all of those contacts from me.
Yes, I'll drop that. And my friend Keith is in the building. Keith, I need to contact you. You're actually on my list. So, yeah, we can do 50 to 100 units plus. We have uh, a vendor that actually funds those bigger deals. So, you have my contact information, Keith. Just contact me.
Awesome.
And give me a second, Tusif, and I will, and everybody, and I will put your contact information in the chat for everybody. Why don't we continue on with your lesson?
Absolutely. You can also drop my socials as well. The next one, as I'm mentioning, after the short term rentals, is infinite banking. That's a powerful thing. I personally am leveraging it. It's more of banking from yourself. What does that mean? So, if someone looks into the banking system, it actually has our money in there and then lends out on a high interest rate and makes its money. But what if we could do the same thing with ourselves and fund our real estate, fund our real estate deals? That's one of the great things I could do. I'm actually personally doing it. Uh, I'm not going to be going into the too much details how and what am I using for this for the sake of time. But on a very broad scale, if structured properly, what you're going to be using is another vehicle, like say for example life insurance. You're going to go back and forth with your lending platform. That's going to be taking loan from yourself, buying real estate, and have your real estate pay for that. And you're not into it with any taxable money. I'm just giving it a pause to settle down because a lot of the times, if someone comes in on a broad stroke, if you are making money, you are touching it yourself, that's taxed. But if you can somehow put another vehicle, say for example, what I'm doing it with another friend of mine is he has a contracting business. What we're doing is putting in another entity. This entity is lending money to the real estate company. And lending income, borrowed money does not have any taxes. And then we are using that platform to buy real estate deals. And then this lending money that it was lent out, if your structure is correct, you can actually defer the entire taxes depending on how much length you want to have it. Of course, you need to be really creative to literally take the entire tax part off with this infinite banking strategy. But you just need to understand you need two vehicles. You do it with real estate. You're going to be making money, taking money from your own business and never have to pay tax on it if done correctly. So I was really excited when I first did it, and I'm on the process of helping two other individuals. Let's see how that goes on. Tax-free money in terms of cash out. I personally did it myself as well. If anyone does not know, Sherry also does hard money lending and the flip lending. So what you do is you buy a property cash as a hard money, even though it's a hard money lend, it's actually regarded as a cash. You come in with still that 20%, buy it as a really undervalued, and then when you fix it up, instead of selling it, go to Sherry again, refi out, make it as a DSCR for long term. That entire money you're going to be taking out as a cash out is going to be tax free. Doesn't matter how much more you make. So, say for example, you bought a property with $100,000, and you got another loan for fixing it up for $50,000, and it ended up in this Northern Virginia, typically $300,000 to $350,000. Even if you take the 70% out of it, you're probably getting another $50,000 on top of that $150,000 being paid off. That entire 50 grand is now tax free. Of course, with the interest rate hike, it's not always doable. You just need to understand and get the deals properly. But if it is gotten, it's absolutely tax free, and you can raise money, your net worth, really, really fast, either with Burr method or SIR method. I'm not going to be going deep into it, but those are two great strategies. Of course, now coming to some less of it. But before I go into this one, I want to make sure that all of these, or if I should say most of these, can be stacked on top of another. And when someone does it, you get the benefit of the cumulative effect of the entire tax strategies. That's how Donald Trump with $9 billion portfolio pays 750 tax. So sit down with your tax planner, understand what they do, and help them. Ask the question. Don't ask the question, what can I write off? But ask the question, how can I write off this income? Understand that question, what you're going to be asking needs to be different when you're going to be strategizing your own tax planning and even legacy planning. Now, some less known benefits. Of course, these are not very used, but with some recent ones, these can be really powerful. Recently, especially in the DC area, there's a big push for solar tax benefits. Now, depending on what size of investor you are, if you are a big investor going for a big size solar, the IRS now allows up to 30% of the entire tax to be written off against your income. So if you're spending $100,000, you're getting all the benefits for free energy. Now your tax electric bill is lower, but you're also getting 30% to write it off. That's a good one as well. Another thing from 2018, that home office deduction is so powerful. I cannot emphasize on it enough. If used properly, think about it. That's what I'm saying. Ask the question, how can I write off everything? Now think about it. If you have a home office for your business, say for example, the room that I'm in, I have six rooms in my house. The room that I'm in is only for office usage. I sleep into another room. My family sleeps into other rooms. And out of the, of course, I'm going to be first writing off my entire interest part, all the taxes part. And again, on top of it, I'm going to be on the principal part, the amount of square footage that I'm using for my office space is going to be also taken away, even if it is on your personal residence. That's how powerful it is. So you're going to be encroaching your money into your mortgage and taking this one off. This is active up until 2028. If you have used it and still did not get the deduction, IRS allows you to correct up last 3 years. Sit down with the tax preparer, go ahead and do that. And interestingly, another benefit of this home office is all the travel to and from your home now becomes a tax deductible travel. That means, say for example, someone goes out to see a property. The travel time to and from the home now becomes tax deductible. It is so powerful for real estate agents. If there is any real estate agent that is going to be listening to this, understand, if you have an LLC, do this and have all of that written off. If you have a vehicle, depending on which strategy you're going to be using, if you have a very expensive vehicle over 6,000 pounds, you might be better off using that write-off for your business purposes. But even if it's not, you can take reimbursement. Last year it was 58 cents per mile. I know the real estate agents typically go a lot of mile just to show properties. Keep a record and always reach out to that with your CPA and deduct it. Last year, I think if you're traveling enough, it can be, I think mine was $5,000-ish. That's how much I actually traveled. Uh, I love traveling. I have out of state investments. Every time I go there, I get that reimbursement back. So depending on where you are, it can be significant. Second one is inheritance trust. That's just so powerful. As I was mentioning earlier, if you're using a trust vehicle on top of a real estate vehicle, you remember the 1031 exchange? That can be completely eliminated when you are dying through this purpose. And even there are some of the other trusts that does some little more creative ways to take away the tax benefits. So sit down with your asset planner and CPA to structure it properly so that when you're actually getting it to your family, they don't have to go through any of the legal hassle and still get the benefit. One of the greatest example of the history of the United States is John D. Rockefeller. Doesn't matter what you feel about him, that guy was so brilliant that his family trust still till this day pays out their family members, and they're getting dividends from that. And of course, the way it's structured, none of the family members can mess it up, because we all know sometimes people who does not earn something, a lot of the times they mess it up. But that sometimes helps out when you are actually helping yourself out. And this is a great benefit for your future generations. And there's a lot more tax credits when you're going to be taking care of your progeny. I'm not even going to those because just for the interest of time. So take care of those, understand those, sit down, plan ahead. That's going to be a great way of tax-free transfer. And an interesting one is IRA, especially the self-directed Roth IRA. One of the most intriguing element of that was the former CEO of PayPal. He put his interest on the company into a self-directed Roth IRA, and it was $6 billion, if I remember correctly, and none of that was taxable. You can do the exactly same thing with your real estate, but you need to
Which
understand
company was this?
PayPal, former owner
PayPal.
of
Oh,
PayPal.
wow. Okay.
He put his ownership interest under that IRA, and more than $1 billion without taxes. IRS actually went to court against him, but IRS lost.
Was it a self-directed IRA or traditional?
I believe it's a self-directed Roth IRA.
Okay, yeah, that would make sense then. Yeah.
Traditional does not give you that much of benefit, to be
No, it
honest.
doesn't. It doesn't. So,
Yes,
yeah, we just need to clarify that that's
yes,
self-directed.
yes.
But
I should.
the self-directed, so I will tell people when we're dealing with private lenders on our end, half of them are tapping into self-directed IRAs.
Yes,
So it's a very powerful tool that so many people don't use.
yes. And you can actually even take loans against it. 401k IRAs. That's also tax deductible. That entire money is tax free. So leverage your retirement accounts as much as you can, but just structure it properly. Next one is family foundation and charity. Trust me, I cannot have enough emphasis on it. It can be actually hybrid with the inheritance, but when you have a family foundation, say for example, you depreciated your entire portfolio. You're not buying anything else. You're just tired and you're enough with your cash flow. Now, if you ever want to move it, you're going to have to pay the depreciation recapture. But if you go through that family foundation, 501c and 501c3, that can entirely, that depreciation can go away. So you are still, if you're someone who is into making an impact with your money, which a lot of us are, you can actually take this tax benefit and transfer your real estate without any taxes. That's hugely powerful. And even if you are not into real estate, I would absolutely recommend you take this benefit. because if you're contributing cash, even if you're W 2 income, you can take up to 60% of all of your income. And if it is an asset, depending on what it is, if it is a public charity, private charity, it can be 20% of your net W 2 income. So just go ahead, sit down with the planner, see if this is something for you, leverage these. This is very little known, but if done properly, this can be extremely, extremely powerful. The next is self-employment tax. If you're that's when remember the four quadrants. A self-employee has to pay 15.3% taxes, but that's different for real estate investing. If you have an LLC, if you are doing a regular business, you're going to pay the taxes. But if you have real estate investment, you are not paying that taxes at all. So these are some of the bigger perks. Now, another juice at the end. I would say meat on the end as well. However, whichever you are into. Real estate professional. Excuse me. A real estate professional is someone who is actually making their living into real estate. The other way someone can qualify for that is if they get involved in real estate activities for 750 hours or more in a year, and 50% of it has to be directly related to real estate. Say, for example, if you are going into sit down with a potential investor, that is something that is a real estate activity. If you have proper log on that, the entire time you're spending going there, coming back, sitting down, talking to them, all of that can accumulate for that 750 hours. And if it does, you can take entire depreciation. So remember, on our depreciation side, if you're not a real estate professional or not taking advantage of the short-term rental, there's a cap how much you can take depreciation in a year. So depending on what type of income you're making, sometimes it's beneficial to do the cost segregation, sometimes it's not. But if you do qualify for real estate professional, always, and if you have those rental properties, always do the cost segregation and take it against it, especially if you're always increasing your portfolio, because the limit of that is gone if you're a real estate professional. And that allows you to take all the depreciation against your active income. So technically, literally dropping your income that is taxable to absolute zero. And if you look into Donald Trump's tax returns, he did make himself qualify for this specific section of the code that is real estate professional. And that is how he was able to legally get away with just that small amount of tax and not pay anything. And if you look into the same thing, you will see for people like Jeff Bezos also didn't pay any taxes for a good chunk of time. That is one of the ways that you can literally get it. The difference between them and average people is average people tends to go through smaller residential ones, which gives them less benefit. But when you're buying a $50-100 million property and you're doing a cost segregation, you can write off millions of dollars just like that. And since they're actually buying those commercial properties, whether it be hotel, whether it be office space, whether it be Whole Foods, whatever, that depreciation gives them the leeway to legally literally vanish the entire taxable event for themselves. Now, we have been talking about a lot of good sides. Of course, it needs to also have some tough part. You need to have the patience, the regularity, the discipline to record all of your events. That is why what Sherry was saying, good bookkeeping. If you don't have that, no CPA is going to be able to help you out. I personally have a bookkeeping service. If anyone wants to do that, if anyone is making good money, I would recommend that always keep a separate bookkeeper and do what you are doing the best is making money. Have them categorize them in a way that your CPA is going to be able to just go and write it off. Sit down with your tax planner for proper structure. If your structure is not proper, doesn't matter what, you will not be able to get certain deductions. It's just how it is. Sit down, understand the tax codes, and do from there. And develop a tax proper planning. Two books I'm going to end with this I would recommend is from Rich Dad series. One is Tax Free Wealth, and other one is Start Your Corporation. Read those and sit down with your CPA, do your tax planning, make more, keep more, and give more. With that, God bless. Now, if you have any other questions, would love to address those. Shri, you are muted. Shri, you are muted.
Sorry. First of all, thank you. Thank you. Sorry. I didn't see any more questions in the chat themselves, but one of my favorite tax deductions are for people who have kids. Uh, you don't have to pay them allowance anymore. They can be a part of the business.
Absolutely. I didn't want to include that. It is another great strategy.
Yes.
Here's I would do it is have them your employee on a corporation, pay
Mhm.
them below 13,000 or whatever that limit
I
is.
think it's 12.5, something like that.
Yes, make it 12,000, make it safe.
Yeah.
$500 is nothing. It changes every year based on inflation.
Mhm.
And whenever you're going to a trip, on a family trip, have them together. The entire family trip becomes a business trip now.
That's
As you're
true.
taking to your business destination, taking your employees, so that means all of that becomes tax deductible,
Mhm.
and you're enjoying your time in a tax-free manner.
And have a business meeting while you're there. That's
Yes,
some of the things that, the people that I know do. They'll have an official annual meeting while they're there. They'll talk business. Also, some of you are doing driving for dollars, or you are doing some basic rehabbing and renovating of your property, nothing crazy. I've known people to take their, 10, 12, 15 year olds and say, okay, we're going to clean out the house, right? And they get paid for it. But that is a great way for them to learn the discipline, for them to learn the business. Some of them do social media really well. There are going to be a lot of people who are going to be looking for answers on social media about being in pre foreclosure, or they call them the 5 Ds, death, divorce. I forgot the others, but you could have them helping you with your social media. Put them kids to work is what I'm saying to you,
absolutely. This
and
is
get a
not child labor.
deduction. Yes.
This is not child labor, and this is actually educating them much
Yes.
more.
Yes. So Five Pumpkins is asking tax-free wealth, and what was the second book?
Start your corporation, both
Start
from
Your
Start Your
Corporation.
Corporation. Yes, both from Rich Dad series.
Okay. Both from
Uh,
Robert Kiyosaki.
I
Okay.
mean, not from Robert Kiyosaki. Tom Wheelwright is his tax advisor.
Okay.
So more of his tax planner and more structure advisors, because uh, the Robert Kiyosaki books are the Rich Dad Poor Dad and the
Mhm.
Cash Flow Quadrants. But there's a lot of other books which are very in his circle, but not written by himself.
But not written by him. Okay. All right. Perfect. Well, I enjoyed myself tonight. I always learn a little bit from you, or a lot, I should say. I guess I'm cheating a little bit because my mother was a bookkeeper for many years, but it's always great to get a good refresher as well with regards to these things. And yeah, I mean, real estate can be a great way to reduce that tax bill. So
Absolutely.
we should take advantage of it. I will also say not only do we have Simply Funded, which also funds your real estate deals, but we do also have a real estate investment network where Tousif and I met. It's called GRID, GRID. If you go to gridinvestor.com, They have real estate groups all over the country, no charge to attend. You just sign up and you come, you network with other people who are real estate investors. So I would encourage you to do that as well. Thank you so much for being here. You're like my first official guest.
Awesome.
Going to be
Happy
doing
to
this
be here
every
as
other
well.
week. Yes, yes, absolutely. All right, everybody. Well, have a wonderful evening, and we'll see you next few days. Take care. Bye bye.
Have a good one. Bye.